There have been other large IPOs by other companies that exceed the $5 billion that Facebook plans to raise. But among the internet companies, among the social media companies, this is by far the largest offering. If we want to get some perspective, the Google offering of 2004 was close to $2 billion. Therefore, the $5 billion offering by Facebook is 2.5 times as big. Also, the recent December issue IPO of Zynga was for $1 billion. So again, we see that Facebook is 5 times that. They are going to now have the opportunity to invest in a company that probably they know very well because they are repeat customers of the company. Not only can participate as consumers in Facebook's future, they can also participate as investors. The relationship is going to deepen for many of those investors. Not that all of them will have an opportunity to participate outright in the IPO, or even later when IPO shares become tradable in the secondary market. But for many of them, Facebook could very well become part of their portfolios. There is a group of wealthy individuals that were lucky enough to participate in a private placement of Facebook shares, especially through Goldman Sachs, when Goldman Sachs acquired shares worth about $1.5 billion at last year's prices, in estimated prices. And those investors probably are going to see an appreciable gain between the price they paid and the price that Facebook will command in the secondary market in a few months. In an IPO, we have two prices that are of interest. One is the fair market price, which we believe the company will command once the trading starts in the open market. The other is the offer price, the price that investors, the first-time investors, have to pay to buy the new shares. The usual practice in Wall Street is that the price, the offer price, is set about 10 to 15% below the fair market price of the security. But the first day of offering, we see a price run-up, therefore, that may be below 15% or may exceed that a lot. So the question is now, for the first time, for the investors that will buy in the aftermarket, to make a very good judgment about the long-run viability of Facebook and its ability to command a price that will exceed the price they will have to pay when Facebook goes public. Google was a success in that case, but Groupon was not. Groupon still trades below or close to its offer price. Therefore, this is something that investors have to judge for themselves. Already there are quite differing opinions about the true value of Facebook that vary from $50 billion to $120 billion. That leaves a lot of room for mismanagement, error, and potential loss for investors. Facebook, if it's going to have the impact that the market expects it to have, has to be very carefully priced so that it is a success not only for the short run and generating profits for those that already own shares of Facebook, but also for the long run. And given that IPOs do not have a very good record in terms of price sustainability in the long run, Morgan Stanley, I think, will have to do a very, very good and meticulous job as they try to canvass the demand about the security and inform investors' opinion about what that value is before they do the pricing.